Okay. How are we doing, everyone? So, as you know, this week was quite interesting in terms of what we've had so far in regards to data. Last week as well. On our last session, it was basically we finished about half an hour before the Fed meeting, and then obviously the Fed meeting came out. We had a decent enough, what's the word I'm looking for? Baseline heading into the meeting in terms of what are we looking for, what are we expecting, what do we want to see, and obviously we'll just discuss that a little bit more in regards to what it means for the dollar going forward. Now, some of you who may follow me on Insta, you may have seen me talk about the NFP data that we saw yesterday, and obviously we saw a little bit of strength, which is fine. It doesn't really change the narrative. I think it was more so just buying the rumor, selling the fact environment, where people bought into the idea that NFP was probably going to be weak because the Fed kind of told us that last week, and then they buy into, and then they sort of exit the sells that they were originally in. That obviously pumps price action higher, and then as you may see today with price action, we are seeing a bit of weaker dollar, which is obviously good news for us because I'm currently long euro dollar, to be fair, and NU. So let's have a little look. How is everyone? I'm good. Thank you, Mohammed. So let's have a little look then as to what we have going on in regards to the calendar. Obviously, we'll cover the calendar. Obviously, if you have any other questions, you're more than welcome to ask it. So let me just quickly change the scene. Now, let's have a little look as to what we've had. Now, to be fair to you, this week is more so largely about what happened yesterday in regards to NFP, the unemployment rate, etc. So mostly the volatility has sort of come and gone, shall we say. Obviously, remember, it is the Christmas period. So what does that mean? It basically means that markets are going to be not very liquid, which actually means generally it costs less to move a pair at that point. That's why stuff like Bitcoin, or not Bitcoin, but like Ethereum, or just lower, less liquid pairs of crypto actually moves quite erratic because it's less liquid. So it's pretty much the same. Whenever you see like bank holidays for the US or the UK, whenever you see Christmas periods, summer periods, you do tend to see quite erratic moves, but it doesn't have much substance. And that's the important thing. You have to think about the context. And the context is it's going to be Christmas period, so you don't look too much into what the moves are saying to us. So let's have a little look as to what we've got, or what we've had, shall we say. Monday, we had CPI from Canada. Now, obviously, these are the two main ones that the central bank actually cares about. And what we saw was those figures coming in lower than expected. What that basically means, right, is, or how you interpret that, as you should generally be doing when you're looking at what data is suggesting. You should be thinking, what does this mean for the theme? So we've spoken about this many times throughout our sessions. The theme is, what is everyone talking about? And everyone right now is talking about the central banks. Cool. So we understand that. What does this lower inflation mean for central banks? That's the question. And given that it was expected to come a tad bit lower, but it came in a little bit more lower, it gave the people an idea that maybe, just maybe, not necessarily what will, of course, because we'd have to see a little bit more data, but we'd have to see stuff like the employment data in Canada's actually been okay recently, surprisingly. It has been in a slump for about 2 years at this point. We have to ask ourselves, does the data still kind of suggest more rate cuts? If it does, then CAD may be a little bit under pressure. But right now, it's hard to say. I'm probably going to leave CAD alone for the time being, at least until the new year, because it's just no point in trying to get punty trades out there when you haven't got too much clarity on the data just yet, because we saw good employment but lower inflation. So it's a little bit, what do we do here? Let's see what else we got. The rest of that Monday was pretty quiet. Now, Tuesday from the UK, we saw claimant counts. Basically, the amount of people claiming for benefits. Obviously, you don't want that number high. And 20K is around average. So it's nothing new. There's nothing much to work with there. It's basically around what the average claimant counts is anyway. So nothing new there. Average hourly earnings. That is wage growth, by the way. And wage growth was a little bit higher than what was anticipated. Previously is obviously lower than where we were previously. But, it just basically suggests that wages didn't fall as quickly as what was expected, but it doesn't really tell us too much. Then we had a bunch of PMI data. Now, it kind of did not point to too great, to be honest with you. However, we have to ask ourselves, right? Each data, like I just spoke about for the CAD, you have to ask, how does this apply to the ECB? And what applies to the ECB is it's not going to change much for the language. So ideally, you would have used like the weaker PMI data that we saw yesterday to get into a long euro, because it doesn't suggest a change in an idea from the central bank. That's kind of how you anticipate it. Then obviously, it was all about US data. Now, let's see what we got. Now, important to note, around when data comes out, you do have revisions as well. Basically, they look at all of the data and then they just look at it as a part of, it's just, we have to look at the revisions as well, right? So overall, the revisions for NFP as well has not been good. So technically, look on here, 64K, a lot better than where we were previously, or it was revised, but it was better. And it was better than the expectation, right? So you have to ask yourself, is this going to change the narrative from the Fed? No. Why is that? Because in NFP, you have revisions. So they get all the data and say, actually, it is now this when we've got all of the data. And what we saw was, if I show you on this little bar chart, revisions, you can see here this sort of darker blue line is the revisions, and this is the last print. So previously, I can't remember, I think it was around where this one was. I think it was around 14 through 10k 5k ish on NFP, if I remember correctly. But what happened is actually they thought, you know what, that print here was a lot worse than expected, and what we saw was a negative 100 and I think it's about 103k revision to that. So it's actually a lot worse. So now if you think context, just looking at NFP on its own, it doesn't point positivity. So that's why on one of the videos I did yesterday on my Insta, I said about how even though it was better than expected, it doesn't change the narrative, right? You have to think context, and the context still points lower for the dollar. So what we saw was a stronger dollar yesterday, perfectly okay. However, it gives me the idea that I want to get in. I'd rather buy or I'd rather sell the dollar at these sort of slightly higher levels that we saw right yesterday, which is perfectly okay. And that's what I did. Euro dollar long was one of the ones that I was looking at. So if we just look at that from NFP, it doesn't point great. But then the unemployment rate as well, 4.6%. Not good, let's be honest. And obviously we don't want that to rise. And it has been sort of trending higher since around, we technically broke above this range that we were stuck in for pretty much almost a year in September, and it's starting to trend upwards now. So it's not good at all. So overall, yeah, it's not looking good for the US. It doesn't point recessionary though. And that's because if you know the textbook, a recession is as such. The textbook suggests, right, a recession is 2 negative quarters. So 2 negative quarters of GDP. And in the US, we haven't had that for a while. So technically it doesn't point recessionary. Employment's not really jumping off a cliff. It's sort of slowing down very nicely. That's known as soft landing. That's very good for equities as well, by the way, and not good for the dollar. So that's what we're looking at. Let me just double check some questions. CPI, we'll have a little discussion. Is there a difference between macroeconomics and fundamentals? No, both the same. Both pretty much the same. Macroeconomics, right, is like everything, I guess. Trading fundamentals in terms of markets, you obviously have to know majority of it. You can never know 100% everything, right? But as long as you know the general terms of what things mean, kind of how things happen, like if inflation rises, what generally happens, maybe we see a little bit of more higher interest rates, yields might go higher. Growth as well is a byproduct of higher interest rates that could struggle in the future. If you just know the general terms, that is macroeconomics, right? But how you trade it in trading is thinking context of markets. So you have to know the terms, the bits and bobs, which can take time. But how you trade it is you think context is X, Y, and Z about the Fed, or it's about, I don't know, weather that can impact How is that going to impact data? How does that then impact the theme? That's the thought process. That's the context. So that's the difference, kind of, I guess, between economics and fundamentals. When will there be liquidity? Probably around middle of Jan. That's generally when it happens after Christmas periods. That's what I've noticed anyway. Around the middle of January is when we start to see people come back from holiday, etc. Mark, when do you think the Bank of Japan will hike? What you think about hike rates in Japan for fundamentals for the US? So that's a good question. So when you're looking at the yen, you're thinking about two things. So you're thinking about, let me just get rid of this text box. You're actually thinking about, obviously, the BOJ and what the data's telling us. So that's about that's the Japanese fundamentals. And then you're looking at the other side of the equation as well, which the US impacts Japan as well, and what they do. So if you see lower yields in the US, you see higher JPY because of the balance sheet. And again, or Japan's balance sheet obviously increases in value, which can bring through positivity for Japan. So obviously, because we do expect slightly lower yields in the US based on more rate cuts, we can anticipate in the future that the yen should be lower, right? So what we have to think about now is which is going to be the main driver of the yen right now, because that's all theory, right? What we just discussed, lower yields, JPY because of the balance sheet, that's all theory, and it will come into fruition, but it doesn't necessarily mean it's tradable right now. Like sometimes people are early to trade, right? Where you might be early and you take a few losses and then you're finally in profit. So what you want to try and do is understand what is driving the currency as of right now. And it's not so much the US. It's like 20% the US. Majority of it is based on the yen and Japan's fundamentals. So obviously we do have the BOJ this week. So they are expected to raise interest rates, right? Which, as you probably know, it is positive for a currency, because what it sees for an investor perspective or like a trading perspective is that it sees as, from an outsider perspective, you can actually get better yield investing into the said country by either buying government debt, investing into companies, doing whatever, right? So raising rates increases demand for the currency, and that strengthens the yen, right, as a byproduct. So we have to now think, what is going to drive this? Well, it's going to be rate hikes, isn't it? Rate hikes, or also known as raises. Remember, if you just kind of, as you probably are aware at this point, people who do fundamentals, they generally try to use fancy terms to say very, very simple things. So as long as you can understand what the terms mean, it becomes a lot simpler. That's what I've noticed anyway. When I started, it was more so about learning what things mean and rather than trying to interpret it. The interpretation comes over time, right? It's just understanding what is a hike, what is a monetary policy, what is an actual interest rate, what is this, what's that. That's all like textbook stuff they can kind of learn. But how you apply it is completely different to what the textbook suggests, as I'm sure you probably are aware. So we know it's now going to be rate hikes or raises, because that's what everyone's talking about for the yen, right? Everyone's talking about Japan. So everyone is looking at the Japan, what the BOJ wants to do. So if they raise rates on Friday morning, this will not increase or strengthen the currency. Does anybody know why I would say that? They raise rates on Friday, the currency is not going to strengthen. Can anybody sort of digest this? Why you may see that? Why do you think that's the case? When I initially said before, raising rates is generally good for a currency, but why would I say now that this is when like sort of context and critical thinking comes through, which comes over time. You're not always going to get it instantly. But why do you think raising rates for Japan is not going to strengthen the currency? Think about context. That's a good one to think about. What do people here think? Let's see. And by the way, If you, for the giveaway today, it's going to be a little bit different because again, one of the guys who sends me the lists is not available today, unfortunately. So the way it's going to work today, only for today, of course, is one of the other mods are going to choose 3 people in the chat, right? So whoever's chatting will have a higher likelihood of getting chosen. That's the way it's going to be done today. Obviously, normally it's not done like that, but unfortunately, one of the guys are not able to make it today to send me the whole list of what the bot says when you press !join. So it's going to be a bit different. It's already priced in. That is correct, right? So that's why we don't really care if they raise rates. Obviously, we want them to raise rates because it does pretty well. If they don't, then it's kind of a rip on the currency. But we obviously know that they're going to raise rates. So that means people have already anticipated it. If you anticipate it, it's 100% sure that the markets have also anticipated it. So it's no longer new news, is it? So what do we look at then to understand if we know Japan is the main driver of the yen right now, we have to look at the future of Japan, or let's say fundamentals, or it's mostly the BOJ is the main driver right now. So we have to look at what the future of the BOJ wants to do. So how do we know that? When Ueda is talking at the press conference, whenever they release any statements, whenever they release any updates to forecasts, this tells us whether or not they anticipate more rate hikes in the future or they don't. Now, if Ueda on Friday, because nobody really knows what they're going to do, but let's say on Friday that they, they are not expected to raise rates further. This is not going to go well for the yen, right? Because that is currently the main driver of the Japanese yen. It's not so much the US, it's about 20% in the US, but it's mostly about, voice break there, it's mostly about what the BOJ wants to do. So we need them to tell us that in the future, they want to do more rate hikes. That's all we're waiting for. Once that comes through, we'll wait for the pullback, then we'll get in, because now we have a confirmation from the main driver of the Japanese yen, which is the BOJ, that they want to go further, and that then strengthens it on the higher time frame. And that's when you see stuff like this, right? We saw a nice pullback. Did we looked at this? Yeah, I think we looked at around this supply zone. Then you can see how price action started the trade nicely lower, which is good news. It's only going to break these lows here once we see the BOJ. So what we want is the BOJ to give us a good guidance on the future. Once they do, hopefully, fingers crossed, obviously, then we'll look to get into some more downside. And how you trade it, as I might have explained it before, but basically when you sell, you want to aim for the lows. So you can see here, I've kind of marked out already, high, low, high, low, high, low. How much more downside it has depends on the fundamentals at that time. So what you can do is probably something like, just trying to see, I think that was, 3-hour supply zone right there. So what you would do, right, is as it trades lower, let's say the BOJ says something, hopefully, fingers crossed if they do, comes lower, what you'll do is you'll trade it to the first lows here. Any one of those is fine. It's completely up to you at the end of the day. And then as it gets into that region, you ask yourself, is the reason it's selling off continuing? If it's a yes, and it's a tick, then when it pulls back, you can never load up another sell, and then you target the next lows, which is right there. And you do the same thing. Is the reason that this sell-off continued, or this major sell-off, if it's continuing, yes, that's when you look at data, etc. If it's a yes, you do the same thing. You wait for the pullback into a supply zone, then you can get in. Obviously, how you do this looks all great on paper, right? But obviously how markets work is completely different. So you do always think context whenever you're seeing pullbacks. What's the reason this pullback is happening? Because I've said this before, pullbacks always happen for reasons. They don't just generally happen. Sometimes they do if like positioning is too stretched to the upside, and we're not seeing no more news coming out. Markets do tend to sort of shave off some of their longs or shorts of their trades that can drive pullbacks. But right now, there's not too much pricing in for dollar yen. So it's more so about what is going to be the reason for those major pullbacks. That's the question you're asking yourself. So yeah, that's what you do. And how you do TPs is completely up to you. If you want to exit the full position at the first high low, that's perfectly okay. If you want to take partials, that's perfectly okay. At the end of the day, it's what's personal to you and what works for yourself. I'm more of a partials person, and then hold the rest and then load up more because I have much more margin on the pullback. That's generally how I like to do it. Some people like to exit the whole position. It's completely up to you. Can you explain more about holidays? What do you mean by that? So obviously in the holiday period, the traders at the desks, they are not here because it's obviously Christmas and summer periods, etc. So they're not able, there's not that much liquidity going around. So what you tend to see is it, instead of costing, let's say, $10 million to move euro dollar by 1 pip, it might actually cost 2 million because there's not that much liquidity. So that's why sometimes on these periods you see very choppy markets, but there's not much substance, meaning there's not much reasoning for it to trade that direction. US indices are going down if the BOJ hikes, taking BTC long. Could be, yeah, could be for sure. What we expect that bonds of the US also go higher. Yes. So obviously yields move inverse to bond prices generally. So if bond prices rise, what that basically means is there's demand for a bond. So for example, for a draw at this little graph. So what generally happens is as the prices rise, let's say this is $20, $30, $40, $50, $60. So as prices rise, let's say it comes to here, it's now $20 per bond on a, let's say 2-year, whatever. Then what happens as it rises and rises, the yield that's offered is no longer attractive for that company or the government to offer out because, well, why are you going to offer out a very high yield when you've got demand for it, right? You want to try and make as much money as you can at the end of the day. So you're going to offer out less because them offering high yields means they're paying out more in the future. So what happens is it's kind of like supply and demand metric where as prices rise and rise and rise, demand comes through, yields come lower. And then what eventually happens is demand dries up because there's not that much yield being offered. And then what happens is people start selling it off. Or they start selling their bonds out, or the government notices that, let's say, the auctions aren't doing too well. So what happens is then demand, or like they offer at higher bond prices or yields, sorry. And then what happens is it's like a supply and demand metric, and then that entices more people to buy it, and then it's chopping up and down. So that's generally what happens. Especially with funds, the Fed is directing the government buying more bonds from the FMC. Yes. Right now, it's not really a main driver, though. Yes, that's all good, what the Fed is saying, but it's not really tradable. That's all we care about as traders is what's tradable, not what like the whole statement is saying. What are they saying about QT? What are they saying about all of this stuff, right? It's not really tradable as of right now. So yes, it looks good. But it's like people trying to trade M2 money supply right now. Can't really trade it because it's not tradable. In COVID, it was tradable. So because loads of companies or businesses were obviously in lockdown, they had to increase the money supply, right? To keep the whole economy lifted up. But they don't need to do that anymore. So it's not really tradable. So yeah, like what they want to do with bonds can impact it, but it's not really the main driver. Is it worth trading next week? No, I personally wouldn't. It's Christmas. It's best to take time off, to be honest with you. Did you watch Powell's conference? Only a little bit. I'll be honest with you. Only a little bit of it. What do you think about his speech for the future? Next question. Most likely he's talking about the labour market. Yes. So obviously what I generally do is I go on Bloomberg and it basically tells me everything. So let me just refresh. Unless I need to open up another thing. So on Bloomberg it generally tells me, so like I don't know if it will have it for tomorrow, yesterday's NFP print. It will look something like, don't know if it will be on here because it's obviously yesterday, but generally what I do is just look at what the live chat is saying. They do have like a live chat on here on big events, and then I'll just kind of gauge through what's roughly being said or not. So most of the time I would watch it, but just This time I didn't watch it. But yes, he did talk a lot about the labour market. So he basically said that there's downside risk to the labour market, largely driven by government. So what we're now thinking about is what is the underlying reasons as to why this is occurring. And obviously it was largely driven by the government shutdown. That's perfectly understandable. However, markets view it through the angle of there's going to be lower growth, there's going to be less inflation, there's going to be less need for rates to be this high, right? Then they're what going to ask is, okay, let's start to bring these rates lower. And as a result, people price in more rate hikes, more rate cuts, sorry. So obviously right now, the dot plot suggests one rate cut next year. Is that really logical given what we've seen with the data recently? I would say not. So as a result, markets will trade in more rate cuts in the future, which drives the dollar lower. Let me see. Friday is seen as, we're pretty much taking the day off or the time off next basically for the next couple of weeks. My question is there an institution mostly most people at the banks are essentially on holiday from this week onwards, really. What framework or signals do you use to judge whether or not the markets will continue? Good question. So I don't care about what technicals are saying, right? I have a view and I'm going to stick to that view. If I'm wrong, it's going to come from I'm being wrong in the data. And then what I then ask myself is, how can I not so much eliminate this being wrong factor, because you're always going to get it wrong at some point. You're trying, how do you learn from that? And that's what I want to try and do. So to understand how much more a trade can go is determined by what the data and the whole reason it's going lower in the first place. If, for example, like what we saw with the dollar yesterday, right? If we look at the DXY yesterday, we saw NFP coming out, didn't really point a great picture. It reversed on itself. We ask ourselves, what is the reason for that reversal? It's mostly about markets have already priced in. They're just taking profits on the sells that they were originally getting in prior to NFP. Cool. We know that. That's called buying the rumor, selling the fact. Does it change the narrative though? Does it tell us that we now need to start buying the dollar? No. So I know that this pullback is not necessary in the eyes of myself. So I know I want to get in a sell, even though we saw a big push. And I'm going to ask the same reason on the way down. Let's say then starts trading lower and lower and lower. What's the reason for this sell-off? If something is occurring that's more bearish for the dollar, I'm still going to hold the sell. If I see a pullback like this, I ask myself, what is the reason for this pullback? It's going to be driven by data, or driven by speeches, or driven external factors. I then ask myself, in my opinion, do I think that that is now a shift in trend? I.e., does now people start going long the dollar? If it's a no, I know it's a pullback to get back in lower again. That's all you're doing when you're each week when things come out. Best week is obviously to around the middle of Jan is when we roughly do it, to be honest with you. It's around the middle of January. There's no point in trying to trade before that. So, yeah, anyway, let's get back onto the calendar. So, overall, let's quickly have a little look as to what else we had. So, PMI data, services PMIs is obviously a lot more important in the US. This is S&P Global, which is a company, by the way, that does the US data. Let me double check. So, if I open up, yeah, it's already open. Perfect. If I just zoom out, there we go. Let me just double check as to what the one I'm more focused on is employment, right? The reason for that is because I don't know if it's shown on the other screen. I don't think it is. What we're asking ourselves is, what is the Fed more concerned about? Is it inflation or is it employment? Well, it's about it's employment, right? They said about it multiple times during their press conference and statement. So any data that suggests what employment is going to do is going to be important. So you turn all your attention mostly onto employment. And what we're seeing here is, let me see. Employment growth has softened in December, although jobs growth edged higher. Blah, we don't care. Service sector employment came close to stalling, with firms reporting the smallest net gain to payrolls since April. Just reading that paragraph, does it point to positivity or negativity? Still points to negativity, doesn't it? So that just adds to the equation of the dollar should remain weaker. That's how I view it through the angle of. Hopefully that makes sense. So yeah, one of the mods are now giving some stuff away to those who have been messaging. Like I said, it's a bit different today because obviously one of the guys aren't able to make it. So we're just doing it slightly different. But yeah, that's what we ask ourselves about PMIs. Remember, PMI data is forward-looking indicator. Basically, it's an indicator that can give us about what guidance is going to be in the future. Not necessarily what will, obviously, but can give us a little bit of an idea of what could happen in the future. Now, what else we had? Today we had CPI from the UK. Now, in the UK, you only care about basically one set of what's the word I'm looking for? You only care about one set of inflation, which is, if I show you, this is a good website to use, by the way, just to get a glance of the data. You only want to be caring about service inflation. Service inflation has now started to trend lower. What does this mean? Well, the lowest we've been there was December 2024. So now the trend has started to come lower. What that basically means now is the BOE may now need to start to be more dovish in the future. How do you interpret that? Well, essentially, more rate cuts in the future. Given what we saw from the government not too long ago, a few weeks ago, we saw issues about growth in the future. So we know growth in the future is going to be poor, and we know inflation is starting to trend lower now. It's finally started to trend lower. Does this suggest positivity for the UK or the pound? No, it doesn't. What that now starts to tell us is we want to start to get into sells on the pound. How do we interpret that? Supply zones only. Which pairs you trade on the pound is determined by which divergence there is. So you then, for example, you think, okay, who is a lot better off than the UK? We know Europe is a lot better at the moment. We know Australia is a lot better at the moment. So those are the two like higher clarity trades for me. So now I know I want to be long Euro GBP and I want to be short GA. Then it's followed by GN shorts. Then it's followed by GJ. Because we know the yen's probably going to strengthen in the future. It's just a bit cloudy right now. So those are the trades we look at. The other ones I'll leave alone because there's no point in me trading it. I want to be in trades where I'm not always guessing where it's going to go. I want to have some sort of certainty where the pair is going to go. So yeah, right now it does look kind of okay to start to get into some bearish UK trades. Let me double check. I just saw a little bit of other questions. Do you think it's good for next year for fundamentals USA that maybe the earlier, because I'm still inflation? Yeah, I mean, what you have to ask yourself is when you're trading, right, you have to be thinking always about what the future entails. You don't have to think 6 to 12 months in the future. Think more so in the next month or two. So in the next month or two, is it more or less likely for the Fed to be dovish or hawkish? They're more likely to be dovish. Why is that? Well, number one, we've seen a little bit of issues in the data started to creep up. Number two, we've seen a bit of more dovish Fed. Number three, we have one of the potential dovish members coming through to replace Powell, known as Hassett. He's likely to be dovish. What does that basically mean? He can sway the Fed or the FOMC to push for more rate cuts. That's why we're still looking for bearish dollar. That's it. That's what we're looking for. So yeah, until it changes, we remain bearish. If nothing changes, we still sell the dollar. If something does start to change, then we buy the dollar. But we don't have to do that just yet. Earlier you told me the dollar at Christmas, you told there would be low volume. So when do you 2020 around January, middle of Jan is normally when people come back from Christmas period. Because obviously there's New Year's, so people take time off for New Year's. And then the week after that, I believe, is the middle of January. Depends when the calendar sort of works out. But it's around the 15th of Jan is when people start to come back. Let me see. Sorry, I'm just reading through some of the comments. Just give me 2 seconds. So should we always question whether price is justified? Yes. If it's not justified, then let's say, for example, like a good example is, right, where I am bullish the pound, but price action is coming lower, right? It's making lower lows and lower highs on the technicals. I'm not buying it until I see price action justify as well, because I'm not trying to buy it or catch a falling knife, as it's known as. So we want to wait for price action to start to turn bullish, and then we start to get in stuff like break of structures. We want it to break above the lower high to create a higher high, very simple technicals, and then we get in because now we have a confirmation. Ideally, we want it to bounce off like a higher time frame demand zone and a big hold level together. Like if we're buying GU, we want it to hit a demand zone, but like 1.30. Like that's big two confluences on technicals. And then we see a break of structure. That's perfect. That's the best environment to be in. But generally, we want price action to be in our favor. How you plan exits and was mostly exits for us. You can do two ways. At the end of the day, it's personal. You could either, let's say we're buying the dollar, right? Which obviously we're not, but theoretically, let's say we are. You can take profit at that first high. You can take profit at the next high. You can take profit when you hit 2% on your trade. You can take profit when you hit 1% on your trade. Whatever you believe works for you as a person. Because trading is personal, right, to yourself. So what I like to look at might be different to how you like to look at it. How you do technicals is completely different to how I do it. So it's personal to yourself. But what doesn't change is the direction fundamentally. Because the fundamentals is cemented data. Everyone talks about, we need data. What are your numbers like? What is this like? But nobody looks at that. And that's why I don't understand, right? So if the numbers are pointing lower, we know we want to be selling. We don't want to be buying. That's something to think about. It's like buying a company, right? If you bought a company, but sales are really poor, their balance sheet is getting squeezed, they're laying off a bunch of people, the CEO's in a bunch of pickle, do you want to be buying that stock anymore? No, you'd rather be selling the stock. So it's the same thing. It's the same scenario, but just for currencies. Are you still hawkish on the New Zealand? Yes, at the moment I am, yeah. Obviously, we haven't got any major data until I think around the 20th of January. So right now, I think it looks a bit choppy on price action, but it seems as if they are starting to turn the corner. The confirmation will come when the data comes in January. So if you don't want to enter New Zealand, then it's probably best not to. I'm long NZD USD because it makes sense as well from technicals and the dollar perspective. But yeah, right now, when you completely turn bullish is when the data tells us, and that hopefully will come in January. 25k for NQ. ES, so I don't really trade equities, to be honest with you. But let's have a look. So right now for ES, let's see. Price action is kind of ugly, actually. It's quite choppy. We don't want to be trading this environment, so we always leave it alone. Always leave this price action alone. This is very ugly. But yes, I'd rather be long ES over time than short it. That's all I can say. So how do we get in? Like, let's say I was longing it. Well, number one, we have a higher demand zone there. It lines up with around 6,700. Let me see if there's any other demand zones. Yeah, I mean, it's quite ugly. The price action is not good. That's the only region I'd want to be long. Unless I see a break of structure at where we are now, then I would get in. But that is not an environment we want to be getting in. Let's be honest. So what I'd want to do, let's say we create a low here, and we close below the low. Then that is the lower low, right? Then that will be the lower high. So I'd rather wait for that and then get in. If we don't come that low. So either one of those scenarios is what I'm looking for. If I were to trade it, yes, but I don't trade it. How are we doing? I'm good, thank you. So each week you will see if the trade you already has, yes, correct. If there's no data that week, then we still obviously remain on the sell. But if something begins to change, then we think, okay, maybe we now need to start to exit. Or if you don't want to exit, you want to wait for a bit more clarity, you can take out half the trade or 3/4 of the trade. It's completely up to you how you do it. But yes, once the data starts to tell us we exit, it's generally when we want to exit. I don't really trade BTC or equities or indices, so I don't really look at correlations, I'll be honest with you. Do you consider liquidity zones or similar concepts? Not really. To be honest, they're all sort of the same thing nowadays. It's just worded differently. But I don't do that, no. GBP is cooked. I agree with that. Yes. Let's see. Mark, how do you train your brain? Remember, I've been doing this for 7.5 years now. So it has come over time. It's not like something you can teach. It's like when people say, what's the word I'm looking for? It's like when people say you have that eureka moment, that now suddenly it all starts to make sense. You just have to wait for that moment to come through. Unfortunately, like I'm not exactly the smartest people. I only just about scraped through in school. So you don't have to be smart to do trading. You just have to have the want to learn to do it. That's kind of what differentiates those average like break-even traders to those ones who do excel, are the ones who actually want to go out and do work. Not somebody that does one strategy and then they're blinded and they don't want to learn new things. Those people are probably not going to do too well, statistically anyway. So yes, that's kind of what I do. Like as a new trader, I know the strategy I use to work in the market, but I need to scalp. Yeah. Okay. So this is the issue, right? The reason I used to do lower time frame stuff, like for those who have been following me for a very long time, know that before COVID, I did lower time frame, meaning more, not like 5-minute or 15-minute, more like hourly trades, like get in, maybe exit the end of the day or the day after, like those sort of trades. Nowadays, I'm more interested in getting in, holding until it tells me to get out. So whether or not that's a month, whether or not that's 3 weeks, doesn't really matter. Once it tells me I exit is when I exit. So you have to just think about what you are as a person. Are you somebody who is more erratic? Are you somebody that's more inclined to be slower? Are you more inclined to want to wait? Have you actually got the time to be on the charts 24/7? Because obviously people have lives at the end of the day. So you have to figure out what sort of person you are as a trader and then mold the strategy that works with your personality. So for me, lower time frame at some point in time when I was starting to grow up a bit, it just wasn't doable. Like I just didn't want to do it anymore. So I had to figure out, okay, what am I as a person? Am I somebody who wants less time to be on the charts? If it's a yes, okay, maybe I want to be more swing trading. And obviously statistically, the numbers suggest day traders lose a lot of money, right? So you want to be going to where the probabilities are. The probabilities are on the higher time frame. That's just what, unfortunately, the numbers suggest. So therefore, I pushed myself towards that. And it made sense because that's just my personality. So yeah, for you as a scalper, you just have to ask yourself the honest question, is this actually who you are as a person? If it's a no, you have to completely change your strategy. If you're new to trading, it's perfect because you haven't sort of got these ingrained strategies in your mind, right? But if I were to trade a different strategy, I don't know if I could do it anymore. I'll be honest with you. I don't really wait for this liquidity stuff, to be honest with you. I don't really look at it. Let me see. Why is the dollar strengthening against the yen? That's a good question. I think it was number one, it was more so what the dollar was doing yesterday. And it seems as if it's just pre-positioning from the BOJ tomorrow. There's no real fundamentals that does suggest yen weakness as of right now. So I think it's more so just positioning, in my opinion. Let me see. Oh, huge divergence in silver and gold. Yeah, you can trade mean reversion if that works for people. But yeah, gold and yeah, I can see that on a percentage here. That's quite a big divergence, to be fair. DXY is basically inverse of euro dollar. So the way DXY works is it's a weighting of, it's like equity, it's like ES, right? Or it's like the NAS. It's a weighting of The NAS is like the weighting of specific companies. The ES is a weighted of specific companies. The DXY is a weighting of specific currencies. So the DXY, I think, is like 56% euro dollar, or just euro, sorry. And then I think his next is either the pound or the yen. So that's why the DXY looks inverse to euro dollar. So if you do that and then we inverse it, which is that one, that's why it looks like euro dollar. Right? So yeah, it is it's just an index. Use it as a rough gauge. Don't use it as a be all and end all, to be honest. That's what I don't do. I just use a rough area of what's happening. You can use the Bloomberg dollar index. You can use US dollar index. I know there's another one. I think it's this one. You can use that as well. All are both basically telling us the same picture. It's just what works for you. I've always used the DXY, so that's why I always do it. Based on bank forecasts, what are your top 3 that you consider? Well, number one, obviously you don't use bank stuff to determine your fundamentals. But if I were to choose banks, I would choose probably Crédit Agricole, who is a French bank. I would choose Nomura, who is a Japanese bank. And I would choose probably JP Morgan. HSBC has actually been kind of poor recently in terms of their sort of outlooks. Morgan Stanley tends to go against the whole grain. Goldman, they are also pretty good. I'd say they're more fourth. It flip-flops between JPM and GS, to be fair. But yeah, you should always, you have your own bias, just then see what other people are saying. The year and the dollar index, same as yes, correct. What do you think is first, fundamentals or technicals? So I will talk about CPI in just a moment. So in terms of that question, I would say fundamentals first. And the reason for that is because if we just stand the DXY right now and we go on the higher time frame, what is the reason why these pairs move? Ask yourself, what is the reason why this happens? Why do hedge funds, these big funds, do they just go into office one day and just look to take out retail traders? No, obviously. They've got better things to do. Do traders at the banks want to do this? No. Why would they want to do that? What do they gain from it? So you have to ask yourself is what is actually driving this market? So you then have to go out and do research. And what I found, and again, if you go onto Words of Wisdom and you look at the recent guests over the last sort of 6 months or so from Riz and sort of the big guys that he's brought on, notice that 95% of them all talk about fundamentals. They talk about, oh, what is the data doing? This is what this is doing. That's what that's doing. They don't talk about, oh, this is what, there's a market structure shift here, then there's a pullback into this fair value gap. None of these big guys talk about it. The ones who have worked at these big institutions. So this is the question I asked myself when I was starting to learn. What is important? So fundamentals drives where technicals go. This is all past data. And this is all what's happened in the past. To understand what could happen in the future, i.e. the ... whether or not it goes ... down or ... up, i.e. when you look at it in a month's time, where is price action going to be? This is going to be driven by a reason. That's going to be driven by a reason. So you now have to ask yourself is what reason is occurring as of right now? And to me, the reason's more pointed downside than upside. So now I know in the future, price action is more so going to go lower than higher. So I know I would then want to position for sells only. That's how I personally do it. That's just the way I've always done it. There's something I'm trying to learn, being able to hold. That comes with time, to be honest with you. That's what I noticed. It comes more with time. Like I said, when I first started, I wasn't a person who would want to hold a trade for a long time. But then eventually, it's just that I just couldn't be bothered to be on the charts more often. So I just had to learn to hold a trade. So what I would do is, or what I did, there was one trade that I took, Euro CAD, and that was back when Trump was coming first into power. When was it? Or it was his second. No, It was one of the debates with Biden. And it told me to sell EuroCAD. So I sold it. But I entered with very, 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 very low risk. So even if it goes straight to stop loss, it's not that big of a deal. But what I use that as is a way to to gain trust in my buyers. So I know at that time I wanted to hold EuroCAD sells. So I hold EuroCAD sells. And I held it and I held it and held it. So I was using it as more of a tester to see how much longer can I hold this trade for. And you'll be surprised. So do some little tester trades, whether or not some demo, whatever, it doesn't really matter. Use it to test your bias. And you'll be surprised. So people who trade for banks mostly swing trade. Depends. Obviously, you've got quants who are high frequency. You have a lot of the time, yes, it'll be longer, higher time frame trends or trades. Sorry. I started off scalping, but transitioned into yes. Again, it's personal to whoever. I just found that swinging is a lot easier for me as a person. Risk management is also very key. That is very correct. What trades are you still in? Eurodollar longs recently, NZD USD longs, Euro New Zealand I am currently, but I think I'm going to exit quite soon. What else am I in? AN, which I am probably going to exit quite soon. And then because it looks like there is some downside opportunity, I think it's mostly those ones. And the other one I am looking at is GA downside, but technicals haven't really been great recently. Did you already cover the euro? No, but I would prefer to be long euro dollar. That is what you said there. Euro holding, ECB holding, to Fed cutting. Yes, that's basically the reason. Yeah, long euro dollar. Most banks are swinging and they have quarterly like they will add. Yes, that is correct. I'm wondering, how many trades do you take on average? It's not so much how many on average. Like, for example, I could take 2 trades in 1 week, but then not take a trade for a whole month. So it's whenever the opportunity comes. Because at the end of the day, what you'll come to learn is it's more about quality rather than quantity. So what you want to be taking is quality trades, not quantity. Quality are the ones that a lot of things, all the stars are aligning. You don't want to take ones where only one little bit is aligning, but you feel like you need to be in a trade. So it's, to be honest with you, I haven't really got an average because it always changes. So like for November, I entered about 3 trades. 3. Before that, it was, I can't remember now, either 1 or 2. And then right at the start of the year, back when all of the sort of, Trump issues were occurring with the tariffs, in May, it was like quite a few. So it's whenever the opportunity comes. Let me see, double check. So yeah. How far do you think Eurodollar is going to pull back? So we've basically pulled back already. So I'm in a long. I'm already in a long, sorry. So we saw that pullback. And what I'm also interested in now is where is it going to go to? Because the pullback happened purely because of people bought the rumor, sold the fact of NFP. So we saw that come through. Basically, the sell on Eurodollar or the stronger US dollar. But then it doesn't change the narrative. So I know I want to be long Eurodollar, right? So what I'm now, so this pullback seems to have been the pullback. So now what I'm also focused on is where can it go to? So this high that we spoke about previously got met pretty quickly. I think it was either last week or the week before. So the next highs now are going to be either 118.200 to 118.750. And then I'm going to ask the exact same question. Does it still make sense? Do I still want to hold? If it's a yes, I still hold. So mostly euro dollar and then CPI tomorrow. So CPI, this one here. ECB probably is not going to say too much just because they just don't need to. But BOE is who I'm more so focused on, because the BOE are expected to cut, but the data has started to turn lower. So do they anticipate more cuts in the future? If it's a yes, then that's the opportunity to get into short pound trades, right? GA shorts, Euro GBP longs, GN would be the third one. So there's a few good opportunities tomorrow. Let's just hope the BOE is quite dovish. ECB, as I said, probably not going to say too much. And then CPI. So what we saw more so focused on about CPI is these two over here. So if I show you these two here. So services and shelter. So services and shelter is who we mostly care about. So on the last print, we saw 0.2 and 0.2. However, what has the overall trend started to show? Well, services has only started to trend lower since July, and that's starting to come lower. And shelter has actually been a little bit sticky. So we need to see what is the overall trend of this. What's the reason why we saw CPI lower? And if it's reasonings that the Fed is going to care about, then that's good news. If it stays the same or is a little bit stronger, shouldn't really change too much because the Fed is more concerned about employment. So, like I said, if CPI is slightly stronger tomorrow, I'm not a person who wants to predict what data is going to do because at the end of the day, there's just no point because it's quite unpredictable. So we have to react to what the data tells us. And that's all I really care about CPI, to be honest with you. I look at rather what these two are doing, what generally is the reason why we saw large upsides. Like, for example, let's say CPI comes in really, really strong. It's only being driven by apparel, for example. We know the Fed just does not care about apparel. You remove apparel out of the equation. If it comes actually in lower when apparel's out of the equation, you know there's downside risks or there are showing downside moves in CPI. So that's what you generally want to do. Is there anything else on here? Not that I really see. ECB, like I said, probably not going to say too much. The BOJ is something we are going to care about. So they are expected to raise rates, but all we care about really is what do they say after? What do they think about for the future? Because that's what's going to drive the yen stronger. Markets already know they're going to hike, so that's not new news. It's about what they say about the future. That's all we care about. So I don't think there's anything here. Let me double check over here. Are there any other trades people want me to look at? I'll double check. I'll open up this actually. It's from JPM, and even like JPM, right? Normally they'll spread it out across different currencies, and you can see that they basically kept it down onto one. Like this is today's doc, right? From their trading floor. So you can see that today they all covered it all on one page. Normally they do spread it out a bit, but it's because it's Christmas. There's just no point in trying to make too big of an assumption. So I just want to double check if they're actually talking about anything. There's a quick uptick on the opposition while the wage growth was muted. There was nothing in the data that would make anyone the Fed change that view. Pricing for Jan, which is basically what we saw. Despite the heightening level of anticipation, the USD closed London session unchanged. The failure of Eurodollar to break 118 was disappointing, so I took profit on some of my longs, while the comments from Trump would retaliate against EU firms. So we saw a tick from 118, which was here. Oh. Yeah, around here. And then we have started to bounce again. I'd still go long. I believe last week she was also pretty bullish Eurodollar from what I saw. I just want to double check if there's anything else here. Which is me more than dollar yen, which has been buying some dollar yen on the 154 handle as we head into the BOJ meeting. GBP inflation printed softer than expected, which has seen pound sold and all but confirmed the rate cuts from the BOE. Nothing really much is being said there. Not that I can see. So yeah, overall, nothing, quite quiet from JPM. I mean, like I said, it's Christmas. Probably no one's going to talk. Scotia, I think they're Swiss. Are they? Scotia, who are they? I'm just double checking. They Swiss? Are Swiss bank? I can't remember. Let me double check what they're saying. Softer and outperforming. The outlook for relative central bank policy continues to dominate markets. So that's the difference between the central banks. And that's what I was saying earlier about when you're trading, you want to be finding divergences. So you're asking, who is the ECB at the moment more hawkish against? If it's more so hawkish against what, like such as the Fed or the FOMC, you know you want to be long euro dollar. If they're more likely to be hawkish against the UK, you know you want to be long euro GBP. And that's what we're doing. So I would agree with that. Widely anticipated to hold is expected to be a constructive outlook and moderately hawkish shift in communication, narrowing the rate differentials. So that would obviously be very good for euro dollar. Then fundamentals, German IFO, yeah, okay, cool. So nothing else has been said there. Let me see. Does that mean the market will be influenced by everything even citizens do? If you're talking about like fundamental stuff, yes, because obviously when they spend over time, inflation does rise or prices rise, and then eventually the central bank will have to raise rates. So yeah, if citizens like us, obviously we do contribute, and that drives where overall sentiment goes in the future. It takes a long time though, but that's all we care. We only care about the near term. We're not really cared about, oh, people are spending a little bit more for Black Friday. Maybe this is good for the data. Well, even if it was good for the data, we know it's only being driven by Black Friday. So yeah, overall, it takes a long time for data to really come through. Because I saw a number of cars bought and so many. Yeah, it can be driven. That's stuff known as as durable goods. So durable goods are stuff where, as the name suggests, durable, where stuff like sofas, stuff like fridges, stuff like TVs, these are durable. They don't just fade away. Non-durable is stuff like food. What are the most important events to look for? Gold. Fed. Right now, the Fed. But generally, you'd obviously have to consider like wars. You'd have to consider whether or not the global economy is going to recession. Gold does very well, obviously. But mostly right now, it's about what the Fed is doing. So we know if rate cuts comes through, yields come lower. As a result, as yields coming lower, if inflation does start to tick lower tomorrow, we can anticipate real yields to come lower as well, which is very good for gold. So that's why if you're long gold already, it's very good to sort of have that confidence to hold it based on what we're seeing. So I would agree with more upside personally. But yeah, apart from that, everybody, is there any other questions for me before I end the stream? You can get fundamental long-term direction, trade on lower time frame. Technically, yes. I personally wouldn't know, because lower time frame is very erratic. Higher time frame is much more cleaner. It has more data in it, so it shows a truer measure. That's why when people mark out areas of demand, the higher time frame you go, the more likely it is to bounce from it. If you find out a demand zone on, like, say, the 30-minute or the 15-minute and compare that against a daily demand zone is more likely to hold than a 1 hour or a 15-minute demand zone. So the higher time frame you go, the more likely you are to hit a trade. That's what I found. So that's why I shifted to a higher time frame. But technically, yes, you could do that. If you have a direction and you only go on that direction on the lower time frame, yes, you can technically do that. How are rising unemployment trends in major economies shaping market fundamentals and valuations? Very good question. So remember, most unemployment rates at the moment are rising anyway. So it's not like it's new news for markets. What we more so consider of is, what is the trend like? Which trend is developing quicker? So we know, like, there's a rise in unemployment rate everywhere, right? So you can't really be like, I'm going to sell the US because lower or higher unemployment rate, but it's kind of happening everywhere as well. So it's not really a divergence trade there. What you're using it with is, how does this apply to the overall trend as well? So if it applies like the US labor market's starting to slow down, a rising unemployment rate just re-emphasizes that. But like, let's say there's been very good employment in like Europe, but there's a slight tick up in unemployment rate. It doesn't change too much because the trend isn't going higher, if that makes sense. So hopefully that answers your question. You're using it more so as a framework rather than individual, shall we say. What major time frame do you go for multi-frame time frame? I start on the daily and then go down to the 4 hour. So for example, if I were to mark out euro dollar, I would basically, because I know I want to be long, I'm looking for daily areas of demand first. So there's a daily area of demand there. So I'll mark it out, which if I show you, I should have marked out already. Yep. Then what I'll do is drop the time frame and look anywhere near term. There's an 8 hour area of demand right there. So I'll mark that out. Remember, the most important thing to remember in trading is nobody knows which zone is going to get hit, right? You need to then use technicals in favor to understand, is this zone the reversal point? We're not so much interested in trying to capture this wick. We're more so interested in capturing the trend. I don't want to capture these lower, very wick time frame trends because it's not sustainable on a long-term perspective. So I'm also interested in getting in the trend rather than trying to capture the wick. That's why I wait for a break of structure. So 8 hour demand zone right there. I'll then drop the time frame just to see if there is any others. There's a 6 hour demand zone there. And then I'll go down to the 4. And you can see that there's also a 4 hour area of demand right there as well. In addition, there's a whole number right there on it. So that's 2 big technical confluences. Daily demand zone, or what was it? 12 hours, wasn't it? 8 hours, sorry. So that's still high time frame. 8 hour demand zone and 117. That lines up very nicely. What I'll then do is I'll then wait for a break of structure. Generally wait for a break of structure. I was a little bit aggressive today, but I was happy to be because margins are relatively okay at the moment. So generally what you'll then do is wait for a break of structure. So the break of structure technically occurs there, right? Because that lower low, that lower high created the lower low. That is not a lower low, or that is not a lower high because that didn't create a lower low. So therefore it's invalid. What you then generally want to do is wait for a break of structure. I'll look at that on the hourly time frame. So if we close above there, that looks pretty good. Then what I do is the same framework, and you can see that there's a 1 hour area of demand right there. There's also a 4 hour area of demand within the 1 hour, so that's also pretty good. And that's all I do. Then wait for a pullback, and then wait for a little bit of reaction, buy it, stops below the high time frame level, target the higher. Target the higher, target the higher. I don't want to capture these crazy 1 to 10, 1 to 20, 1 to 30s. We all know that that is not sustainable. If somebody can do that on a long-term perspective, they will be the best trader to have ever existed. And we know that is never... I've seen this come and go so many times. This whole premise of trying to capture these 1 to 30s, 1 to 20 trades. I've seen this over many, many years. It's like a theme that just comes back. So think logically. If you're in a trade and you're in profit, you're going to make money. That's all you care about. So don't try and capture these crazy risk to rewards. 1 to 2, 1 to 3, 1 to 4 is perfectly okay. What platform? MetaTrader 4. Yes. Weekly, any really, but I'll go down to the 4 hour to find a demand or supply zone, then drop to that hourly for a break of structure. Then I get in. I use weekly and monthly key levels. Yes, you can also use that. Have you noticed price action reacting to weekly? Yes, for sure. So stuff like here is actually kind of a good one. Where is there any supply zone being... I mean, there is technically a supply zone there on the daily. But also, right, if somebody said that there is a supply zone right here and I'm going to sell it there at the supply zone, you would have got in. If somebody said I'm going to sell it at 118 because it's a whole number, you would have got in. That's why every strategy works to their own degree. It's just about you as a trader, you have to figure out what is the market like at the moment and which strategy is more likely to occur. That's all you're doing. So if you have a couple of different strategies in different market environments, you're covered in all aspects. So yeah, I have noticed that as well, that they do tend to react out of high time frame levels like 117, 120, 125, etc. around news. Well, if it does react from there and it's opposite to what the news tells me, I'm only using it as a pullback opportunity to get in. That's all I use it for. Yeah, don't forget to check the other time frame often. Checking the high time frame, we get stuck. Yes, that is true. A lot of people do tend to get stuck on those lower time frames. It's a bit unfortunate, but I think it just comes down to experience, to be honest. Like, we should all be checking the higher time frame, really, to get a bias. To have a, even if you don't trade much fundamentals, just to at least get a bias. And why are people not doing that? That's the question. I think it's kind of like very tunnel vision on the lower time frame. Do I go for fixed? No, I don't. I go for a band. So my risk is a band. Basically, anywhere between 0.5% and 1.5% risk per trade, obviously. Then you've got to think about, how exposed are you on a portfolio perspective? Are you exposed 10%? Obviously, that's pretty nuts. So you have to think about in relative terms to your portfolio, but also think about in confidence. So if I'm quite confident, I'll enter more like 1%, maybe a little bit more. If I'm not too confident in the trade right now, I'll enter 0.5%. So that way I'm covered that because I was not confident, I only took a 0.5% loss, which is not that much. But if I'm quite confident and everything lines up, I want to capitalize on that. And that's why I have that. And then where I take profit is purely dependent on what the data tells me. Gold, good question. So gold, I'm still looking for longs. We didn't pull back this deep. So this is kind of a live example now. Let's look at it. So what I will do then, because we didn't get in here, we didn't get that pullback to this demand, this high time frame, 12 hour to 4245 region or 4250. Let me just 4250. This region. Wait, why has it gone to 6? There we go. Because we didn't get pulled back into that region, it lines up with prior highs. It's also a 12-hour demand zone. Yeah, looks like a 12-hour demand zone. We didn't get pulled back into that, which it is what it is. It's not that deep. What do we do is we have to wait for, let me delete this because it's old now. What we have to do then is just apply the same logic. So we know we want to be long because fundamentals tells us, right? So there's a daily demand zone right there. Then just drop your time frame and see which areas of demand is forming. We can see that there is a 8-hour demand zone right there. It's actually a bit of a 6-hour demand zone right there as well. So what I'm going to do is as follows. Wait for the break of structure because this confirms the sort of leg you want to be looking at. So once we get a break of structure and a close above the high, then a pullback into around 1430, basically into this region, and then go on the higher time frame and then target. Obviously at that point we would be at all-time highs. So what you will then do is just target the next whole number. So the next whole number above here would be 14,400. Well, I keep saying 4,400. And then after that, maybe you can take it out and then re-get in because you're at all-time highs at that point. But yeah, generally you'd be that. You could target the first high right here. And then after that, you're at all-time highs. So now you have to work with whole numbers and think 4,400, 4,250, 4,450, etc., etc., etc. I haven't got time for another example. I'll do that for the next one. I am a little bit cautious of time. We have run over quite a bit, but I will be ending the stream quite soon, but we'll cover that next week. Or whenever I stream next. Please, can I get a little help on the applier, demand, and supply gold? You can send me a chart in the Discord. Just send me a DM in the chart of your chart, and I'll have a little look at it in the Discord. But yeah, apart from that, everybody, I think that's myself. I appreciate you all for being here, obviously. And I will see you when I stream next. I'm not sure if it'll be next week, because obviously it is around Christmas period. It might just have to be the week after. Or the week after next. I'll let the guys know, of course. But apart from that, everybody, have a good rest of your week. And I will see you again soon. Take care, everybody.